we're going to show the $64,000 of our share of the income from the subsidiary. We're going to reduce our investment in that amount. Then this $40,000 will increase investment in pawn and credit our dividends declared, similarly to how we've done it in the previous chapters. Then we need to take into account our amortization. So our amortization and the depreciation, we have $6,000 of amortization, we show $5,000 of interest, $1,000 of our equipment, and then we're going to, again, show our amortization of the various excesses, the depreciation that we, remember, are reducing because it's a negative number, the patented technology, and the long-term liabilities, which I thought was just $4,000. I thought the excess amortization was $10,000. Let me go back in here real quick.
I have a quick question.
Yes.
So, in entry A, if we took the 1,000, 6,000, and 5,000 out, so is this entry kind of just putting it back up?
This is to accrue it for the we do that each year. So when we took this, let me just make sure, this 1/115. So we've got our consolidated entries showing the amortization already taken as we consolidated the financials. To recognize current year excess fair value amortizations.
So entry.
This is at the, but it looks like we're doing this twice.
It feels like it.
It feels like
And
it.
it's not called long-term liabilities in entry A. Does that matter? I'm assuming it's. I didn't know if you do this. Do you do entry E both years? I mean,
You do
or all these?
the very first to consolidate the financial statements. You see, we in the past we have not done the net amount here. Do you know what I'm saying? In the past, we would take these amounts in full, just like here. Okay, non-controlling worksheet. We would take it just like this. We'd show the common stock, but no, you see the equipment we're showing less, 1,000. We're showing our patented technology less 6,000. And this is as of the beginning of the year. That is, let me just go to the book a minute. So let's go back here. This all makes sense. We understand how the income is being reported by pawn. Then we understand what we need to show in the equity, our portion of the equity. See, as indicated in 4.3, I think what they're doing, it should only happen once a year. And so we can see that they're already showing that in that initial acquisition. So let's go on and see. To me, it seems like it's being doubled up. Or they might be explaining how you calculate the figures, but then they go and want us to amortize it again, and it only needs to be amortized once. And truthfully, guys, just like we've done in previous chapters, we allocate the excess amortization to the various assets, but we usually don't then do the amortization until the end of the period. So that's where I'm a little confused as to what they're trying to do there. But no, it usually only is allocated once a year. So as we look here, let me just go back here. Let's go back to this portion. So as we look here with this particular consolidation entry showing our various recognized current year excess fair value amortization, this should be an adjusting entry E on its own that isn't showing this consolidation here with A, because this looks, it'd be different. We purchased it at the very beginning of the year, so we're not dealing with in the middle point of the year. So we'll have to look at some problems and see how it gets played out. But we are going to do an annual consolidated entry to show those excess amortizations. Now, how do we handle the non-controlling investor section? Basically what we're going to do is the net income gets computed at the combined entity level, and it gets allocated to both the non-controlling and the controlling interests. And then our statement of changes in owner's equity is going to show how the ownership changed within the year. We are only going to do problems where the ownership began at the beginning of the year. We're not going to show steps of continuing increasing ownership throughout years, or we're not going to show purchasing the ownership in the middle of the year. I'm going to keep all that out for this chapter, okay? Let's keep it simple as we can. Okay. So, in this situation here, the consolidated financial statements are going to show revenues of $1,340,000. If we look at the book, it shows how do we consolidate these? The revenues of the parent and the subsidiary get added together. So even though King's only going to show 80% of it, we're going to, in the consolidated totals, show the entire revenue. And basically, if we go back to the revenue section here, let's find it, where it shows the revenues of both companies. Let's see. Page 159, thank you. So our revenues here, the 910 and the 430 are going to get combined, right? And that combination here is going to show up in our consolidated financial statements. The cost of goods is going to be combined. 544, we got our 344 and our 200. Then our depreciation expense is combined minus that 1,000 depreciation. Our amortization expense of 181 is going to be the 100 plus the 75 plus the 6,000 of amortization we showed on this previous journal entry. Here, you see this amortization expense? So we're going to combine both of the companies, but we also have to take into account our adjusting worksheet entries. Okay? Then we have interest expense of 120. The 120 is going to come from the 70,000 plus the 45,000, and then also the journal entry up here that takes into account our additional interest here of 5. So it's combining them and making sure we also add the consolidated entries. Next, we're going to then we show what our consolidated net income is. Now here's where we show the portion of this that's going to the 20% owner. So we're going to show here the 20% consolidated net income to the non-controlling interest of $16,000, and the $400,000 is ultimately going to go to the 80% we own plus 100% of our business. So if we go back here, we show the allocation, and we show here on our statement of owner's equity what we started the period with, what we're adding as income, and what we then subtract as dividends to get our ending balance. And then in our equity section, this is different. The way we account for the non-controlling interest is we include that in our equity section. Okay? So that portion of the business, in other words, since we're combining 100% of it, we need to show the portion we don't own. And that non-controlling interest is going to become part of our equity section, stockholders' equity section. That's where it changes a little. Gets a little more confusing. How are we going to show our assets? We should be able to pick the assets from both companies, and then from there, any amortizations we've included should consist of these different figures. Our long-term liabilities should be combined, minus any amortizations. And then we've got the ending balance, the $870 common stock, which basically comes from here. We've got then the retained earnings of $1,200,000, which comes from the retained earnings section, and our non-controlling interest of $213 shows up here, all in owner's equity. So do you see we're showing it at 100%, but the way we allocate it is we have to show in our equity section the portion we don't own. Okay? When we pay excess because we want control, then what we show here is the fair value. So basically, instead of buying it for just the share price going market rate, we're buying it for excess. So in this scenario, the fair value at acquisition date, instead of paying $9.75 for it, we paid $11 for it. So do you see our controlling interest is at $11 times those 8,000 shares. Now the controlling interest is still sitting at $9.75 a share, the 2,000 shares they own. So because we paid excess, that's only going to affect us, the controlling portion. The non-controlling interest is going to stay the same. So as you see, after we allocate the identifiable assets, you see here now our goodwill is $120. The non-controlling interest goodwill is still at $5. Why do we do that? Because we can clearly trade this on the stock exchange, and we know that the share price didn't change even after we bought it at a higher price. Okay? So the goodwill is attributable solely to the controlling interest because we're buying it because we want control. We're not going to worry about the initial value method at all or the partial equity method. And we're not going to even focus on mid-year acquisitions. Now, mid-year acquisitions are called step acquisitions. Or, excuse me, mid-year acquisitions are when they buy it in the middle of the year. Step